Hello, wise investors, and welcome back to the Dividend Uncle channel. Some of you may know that the Dividend Uncle is a long-time investor of CapitaLand China Trust. Today, I'm thrilled to share some golden nuggets I uncovered during a recent adventure at the Corporate Connect webinar, organized by the Securities Investors Association Singapore or SIAS, on CapitaLand China Trust, held on September 26, 2023. Joining such events is like cracking open a treasure chest of knowledge. And guess what? I've got 5 sparkling gems of insights to reveal from this enlightening session, from the CEO of CapitaLand China Trust. So let's dive in. 1. The strength of underlying properties. Our journey begins with the foundations, the underlying properties of CapitaLand China Trust. Imagine strolling through a garden of resilience where both the retail and business park sectors bloom with positive rental reversions. The Trust's focus on tenant sectors like electronics, engineering, and domestic consumption, in sync with local government policies and China's priorities, has been a winning strategy. However, there's a cloud on the horizon, my friends. Management hoisted a caution flag on the logistics sector. It seems this ship isn't sailing as smoothly, with decreasing occupancy. The culprit? Several existing tenants hitting their first lease renewal round just when there's a surplus of supply, especially in Tier 2 cities. Managing interest rate risks. Our next stop on this adventure takes us to the intriguing realm of interest rates. CapitaLand China Trust's management is no stranger to the interest rate roller coaster. They've opted for the cautious route, ensuring that 70% of their debt is securely hedged to fixed-rate loans. Moreover, they steer clear of a debt avalanche by not letting more than 20% mature in any single year. But here's the kicker, they're actively pursuing ways to trim their interest expenses. Picture them shuffling their debt deck from offshore to onshore, especially as the interest rate tide in China's onshore waters seems more enticing than offshore waves. To explain quickly what onshore versus offshore debt is, management said that if you look at the currency of the trust's debt, you can see that currently the trust has a lot of offshore debt such as Singapore dollar debt, despite the trust being entirely in RMB. The reason is because it used to be cheaper to borrow in Singapore dollar than in RMB. Over the past year, interest rates have been rising in most countries other than in China. This has resulted in onshore debt, that is debt in RMB, having lower interest rates than offshore debt. The steady shifting to onshore debt will result in lower interest expenses. So, watch out for that interest expense drop coming in the second half of 2023. 3. Tackling the currency conundrum. Now, currency risks are like hidden traps in the investing jungle. But CapitaLand China Trust has a sword to fend them off. They're acutely aware of the currency dragon when investing in CLCT, which is essentially investing in China with RMB currency risks. They're not playing the odds here, they've got a strategy. They're focused on protecting their distribution per unit, or DPU, by hedging more than 50% of their distributions. It's like having a shield in the face of a foreign currency storm. 4. China's unique work culture. Our journey takes an interesting turn when we delve into the work-from-home phenomenon. While other business park and office REITs might be feeling the remote work vibe, China has a different rhythm. Here, employers drum a return to the office beat as soon as COVID restrictions lifted. Why, you ask? It's the Chinese work culture, offices are where the action is. Plus, let's not forget, many folks don't have sprawling homes for comfy remote work. As for CapitaLand China Trust's business parks, they're occupied by tech, healthcare, and R&D sectors that thrive on office collaborations. 5. CLCT, your Chinese growth proxy. And now, we arrive at our grand finale. Investing in China isn't a stroll in the park, but CapitaLand China Trust offers a shortcut. It's like having a key to the kingdom of China's growth story. With exposures in retail and the new economy sectors of business parks and logistics, it's a robust portfolio. Here's the kicker, it's sponsored by CapitaLand, a heavyweight owned by Temasek. That's like having a financial guardian angel. Strong corporate governance, dividend yields over 8%, and the potential for share prices to soar when confidence returns to China, that's the treasure trove CapitaLand China Trust presents. And there you have it, my friends, 5 captivating insights from CapitaLand China Trust management. Investing in China's potential can be a thrilling adventure, and this trust is your trusty steed. I have also provided the link to my earlier video, where the Dividend Uncle explored whether the recent crash in CapitaLand China Trust prices presents a unique opportunity, or is a value trap to be avoided. Take a look. If you've enjoyed this journey into the heart of Chinese real estate, give this video a thumbs up and don't forget to subscribe for more financial adventures. Have your own insights or questions? Share them in the comments below. Let's spark a conversation. Until next time, stay informed, stay savvy, and happy investing. See you in the next one.